Hello there, this is James and you're watching Tixee Live Presents #AskJames. In today's little educational video, our subject of the day is an introduction to chart patterns and an introduction to pivot points. Now, before we get into that, don't forget these little videos are for educational purposes only, and in no way whatsoever should ever be taken as financial advice. I always suggest you do your own research and do your own due diligence, and of course, know the risks at hand before entering any trade. With that out of the way, let's get started. So like I said, today's episode of #AskJames, and as you know, those who are new to the series, it's a little bit different from obviously the normal Tixee Live broadcasts, which are more market driven. These are educational based, where we where you good people pick a topic of your choice, anything related to trading in the markets, and then we dedicate a whole live video, just to cover that topic. And today's topic is chart patterns and pivot points. And this was suggested by viewer Skyweaver57. So a big shout out to Mr. Skyweaver or Mrs. Skyweaver57 for this topic, because I say it's a very fascinating topic. And when you have a good sort of firm understanding of chart patterns in particular, and then pivot points, it can indeed assist you and help you with your trading. Now, don't forget, like I always say, these little videos are basically an introduction, okay? Introduction to chart patterns. There's like a bite-sized piece of information. It's like I say, it's only an introduction today. We will be doing proper, full-blown webinars in the future where we go into a lot more detail on these topics, but today it's just a bite-sized piece. So anyway, let's get started on it. First of all, what are chart patterns? A very simple question to ask to begin with. Anyway, chart patterns are a very popular form of technical analysis and can help traders spot conditions where an asset is preparing to break out in a certain direction. Chart patterns can also indicate whether the asset will continue on its current direction or reverse. Chart patterns can assist traders with 1, identifying potential entry points in a rising and falling market, and 2, identify when to potentially close a trade, either to take profit or to control your loss. In other words, take your loss. So here's the thing. Like I say, today's an introduction, and there are many, many, many different type of chart patterns. Today, I think we're going to do 4, an introduction to 4. And the first one we're going to discuss is one of the easiest to understand and easiest to look out for is the double top. Okay, a double top. Now, a double top, okay, is a reversal pattern. This can form after there's been a large move higher. These so-called tops are the peaks of an asset that is formed when it reaches a certain level which it cannot be broken. Once testing this level the asset will fall back. Once testing this level the asset will fall back slightly before returning to test that same level again. If the asset breaks down again after touching that level, then what you're seeing is a double top. This is a potential signal that a reversal is about to happen in the market and buying pressure is decreasing. So let's have a look actually what it looks like. It's a little visual aid to look like. So here we go. This is an example of a double top. Okay, a double top. As you can see, the market's on the move higher, hits a certain level, can't break it, and starts to reverse back down. Again, the buyers come back into the market and pushes the asset up higher again to do to the same level, and it cannot be broken, and it then starts to fall back down. At this point, we can see it's formed what's potentially known as a neckline, as you can see, just there, a neckline. If it then breaks through that neckline, then what we're seeing a reversal of that trend. Now, I've got an example here to show you, actually on a chart itself. This is the cable, the British pound US dollar. As you know, I speak a lot about a British pound US dollar. Okay, so this is where we can see a double top. The market starts to move higher, hits a level, cannot break it, starts to fall back down. Then it again attempts to break that level again, a double top. Then reverts back down and then breaks through the neckline. Let me put the lines in so you can see it a bit more clearly. So here we go. Here's the double top. Okay. And here is the neckline. Here is the neckline here. as we can see, try to move up again, hit the top, hit that level at a certain point, couldn't break through, moved back down, then had a second attempt at it, couldn't break through, and eventually went through the neckline, and we had a reversal of that trend. So there's an example of a double top. There is, of course, a double bottom, surprisingly, a double bottom. And a double bottom is basically the reverse of this pattern, where you see an asset fall down to a certain level, find a support, and bounces back up again. And then it tends to do it again, hits the same level, and the market bounces back up again. Okay, this is known as a double bottom. And again, it forms some form of neckline. And if it breaks through that neckline, again, it indicates to us a change in direction. Right, the next pattern to look at. And this is a real difficult one to spot. It's very popular. Excuse me, it's extremely popular in the market, extremely popular with traders. But in my opinion, it's one of the most difficult because it can be very misleading if you see it or not. Okay, it's all down to your, the way, if you can see it, it's all down to your mind if you think you can see it. So it's a bit of a difficult one, but everybody talks about it and everybody mentions it. And this, of course, is the head and shoulders pattern. The head and shoulders pattern. And this is what the head and shoulders are. The head and shoulder pattern is a reversal pattern where a peak is formed, first peak, that followed by a higher peak, and then followed again by a lower peak. Okay, so the asset goes up to a certain level, forms the first peak, which is a shoulder, so to speak, then goes to a higher peak, which is known as the head, then falls back down again, and then tries another level, again forming the shoulder again, the second level, and then breaks down. Again, it forms like a neckline, and it looks a little bit like this. Again, as you can see, moves up, hits a certain level, forms the shoulder, falls back down, penetrates, goes past where the shoulder was, forms a top line, becomes the head, falls back down again, forming, now we can see, start seeing the neckline. You see the bottom line of that? Goes up again to a shoulder level, the second shoulder, then breaks down again, breaks through the neckline, and we have a reversal in that trend. Again, found an example, because like I say, the problem I have with this particular pattern is many people think they can see it, but it's not actually there. It's how you interpret it. How you interpret it. But I have found an example again. This time is on the euro sterling. Okay, this is the euro sterling we're looking at. Right. Let's have a look. Where did I see it? Here we go. Pull out a bit so we can see a bit clearer. Here we go. Here we go. Here we go. Here we go. So, market starts to move higher. Hits one peak. Okay? All right? So that's the shoulder. Then goes higher again. Forms the head. Falls back down. Moves up again. Again, forming a shoulder. Comes down again and breaks through the neckline, reversing the trend. Let's put some lines in so we can see it. Okay, so there's the first shoulder. Here's the shoulder. See? The shoulder pattern there. Then we can see here is the head. And then if we see the start of when they both them try to move and form the second shoulder, it's difficult for me to say shoulder, isn't it? Is the neckline. And that's then when it breaks that, it reverses the trend. So there you go. That's an example of the head and shoulder as well. There we go. Let's delete these so we can clear up the screen because we've got plenty more lines to put in a bit. Moving on. So, like I say, the problem we'll have with the head and shoulder, like I say, again, it is a good pattern to watch. And if you do see a clear pattern, then it can potentially be a really good indicator that obviously the market's on a move. But again, it's all down to your interpretation of it, if you see it or not. So it's all down to that. So that's my only criticism of that particular pattern. We now have the pendant pattern. The pendant pattern. And this is, we're going to talk about this in a bearish pattern. Okay, so what this is, let's pull up my slides again. Okay, this pattern is a continuation pattern formed after a big move in the market. And it's formed because when you witness a big upward or downward move in the market suddenly pauses to catch its breath, has a breather after a little while. Before then, the momentum then continues. And it looks a little bit like this. This is an example of a bearish pendant. So as you can see, we've got a downtrend, downtrend. It then comes down a little bit. The reason for that, of course, is say the sellers then, for example, you know, do a bit of profit taking. They start getting out the market, but the pressure's still there in the market to sell, but there's not a big enough momentum because the market is having a breather. Eventually it does break out and it does actually carry on with its downward trend. Now, let's have a look at the example of this as well. Right. Let's pull that to make it a bit easier to see. Okay. Let's go back to the sterling again. Okay, the sterling again. Here we go. Right. So let's move in a bit closer so we can see it a bit better. Okay. So here we go. So we've got downward pressure here. And then the market starts to come down a little bit. It starts to have a breather after this big move. To this big move, it starts to come down a little bit before finally breaking through again and carrying on its direction. Because eventually, like I say, after big dramatic moves, the market needs to take a breather to catch its breath before it can then proceed again. Let's take rid of that. Right. We've got one more pattern to look at. And that is the ascending triangle pattern. Trust me, these chart patterns have a lot better names than candlestick patterns. We don't have like the abandoned baby or the falling star. But anyway, they have, you know, pretty practical names. Now, the ascending chart pattern, okay, occurs when an asset has hit a resistance level where there's a slope of higher lows. I'll show you what I mean by that visually in a minute. This happens when the buyers are having difficulty to push the asset past a certain level, like it's hit a resistance, for example. However, they start making ground, hence the higher lows, which eventually breaks through that resistance level. But, this is always the word of warning I have on this. Be aware, though, that sometimes the resistance proves to be too strong and the buyers run out of steam. So then you see reversal. So it's often best when you see this pattern to prepare for potential both outcomes. Now, we have got an example of this again, as well as this. Let's have a look. Shrink me down a little bit. Sorry, throat's a bit dry. Right. This one is the euro dollar. And this is interesting. Remember what I said. It sort of runs out of steam, hits a resistance. It basically hits a resistance and runs out of steam. But then you see a slope, a lower lows. Okay, lower lows. So this is the euro dollar. This is on an hourly chart. So here's the resistance here, as we can see. It tried and it ran out of steam. But now, as we can see, we can now start seeing a slope form of lower lows. Look. Lower lows. See? Lower low, first low, lower low, lower low, lower low, lower low, lower low. And depending on what this candle forms today, that's potentially another low. So does that mean the market can build up pressure to break through this level or break through that level? And this, this is what it looks like visually. Okay, another example of that. So if I have a look at visually, okay, so this is because this chart pattern can be really difficult. Okay, it's like sometimes it will break through that resistance level, sometimes it doesn't. Some traders, what they look to do, okay, they look to possibly put a buy order above the resistance level and a sell order below the slope in case that, like I say, the buyers run out of steam. Okay, if we go back to the chart. So what some traders do, okay, like I say, if they could see this formally, they would maybe consider doing a buy order above the potential resistance level, and then maybe a sell order just below the slope level. Okay, so that's what some traders look at doing to protect themselves on this particular pattern. Because, like I say, this pattern again, like all patterns, to be fair with you, as I often say, trading's not that easy. Patterns don't always work exactly how you think they should do. So you always need to make sure you're prepared to protect your losses as well. So anyway, that's the ascending triangle pattern as well. Okie dokie. Okie dokie. So moving on now to the next part of this little video. Again, like I say, this is just an introduction. Just an introduction to chart patterns, okay? We will do a full-blown educational video later down the line. We'll go into a lot more detail because, like I say, there are many many chart patterns. Today, I've only gone through 4 or introduced you to 4 patterns, okay, 4 the most popular. But in the future, we will do a bigger episode on that. But as we're at it, I want to do a little bit about pivot points because this was the request by SkyViewer57, okay, pivot points. And with this, you could do this with me, okay, because we can get a calculator and do it together. Now, pivot points, what are pivot points? Pivot points are a technical indicator to help traders identify market sentiment and potential resistance and support levels, okay? Potential support levels, all right? How you do this, okay, is simple. This is the calculation you can do yourself, and it's a very, very simple calculation. What you do, you take a high of an asset from a period of time, plus a low of an asset from a period of time, plus the closing price of that asset in that period of time, divide it by 3, and it gives you the pivot point. And here's the theory behind the pivot points theory, okay? So here we can work out with the pivot point, and I'll show you how we do the calculation in a minute. We can calculate the resistance, and we can calculate a potential support as well. And the theory is, okay, we've got our pivot point, okay? The theory is if the asset's below that pivot point, then it's bearish. If it's above that pivot point, then it's bullish. Okay, and that's how you work it out. As well as having the resistance and support, if the asset is below that pivot point potentially first acts as the first level of resistance. And if it's above that pivot point, then the pivot point can act as the first level of support. Okay, and don't forget, like I say, I'm a big fan of knowing or always looking at the fact that you know, when the resistance is broken, it changes its lifestyle, it changes its role, so to speak, and becomes support. And when a support is broken, it changes its role again, becomes a resistance. So this is a big thing about it. But anyway, let's go through how we calculate it. Okay, how we calculate it. So we calculate it a little bit like this. Okay, to work out the resistance, like I said, it's the high, low, close, divided by 3, gives you the pivot point number. Okay, so we then get that pivot point number. Okay, we times that pivot point number by 2 and take away the low, and that gives us the potential resistance. Support, get the pivot point again, times it by 2. This time we take away the high, and that gives us the potential support. Now let's do an actual example of this. excuse me. So I've taken the British pound US dollar, okay, the cable, over 4 hours, okay, and I've looked at the high of the British pound in those 4 hours, which is 1.13667. The low of the British pound in those 4 hours, which is 1.12788, and the close of the British pound against the dollar in those 4 hours, which is 1.12883. I've added them together and divided them. It gives me the pivot point of 1.13112. So I've got my pivot point. So I then times it by 2, take away the low, gives me a potential resistance level of 1.13667. Take that pivot point again, times it by 2, okay, again, and take away the low of 1.12788, gives me the potential resistance. Okay, so let's bring the British pound up now. So on the 4 hours, I said I did this on 4 hours. So here we go. So I got, this is from the last 4, that's the last 4 hours, okay? So let's have a look. So we have potential pivot point, which is 1.13. Let's do this closer so I can see properly. There we go. That's not the British pound, is it, James? Actually, let me put me on my chart. I forgot my chart again. I'm too busy thinking. Right, let's bring the British pound up. Okay, there we go. It's better. So we've got our potential pivot point of 1.1366. So 1.133, let's try that again. 1.13112. So, okay, 13112, which is around about here. There we go. Yeah, perfect there. Now we've got a potential high, 1.13667. 1313667. No, sorry, the first resistance was 1.13. So I times 1.13436. So there's our potential resistance. Okay, so there's our potential resistance there. And our support, we times the pivot point by 2, took away the high, 1.1255883. Was it 1258? There we go, round about. That's it, about there, 1.258. So there we go. So those are our potential resistance and support levels and our pivot. So going with that theory, it's below the pivot at the moment. So potentially it's actually bearish and it's testing that first support we've put in with the pivot points of 1.125. So that's how we calculate pivot points. Obviously, there's other pivot points where you go to the second. I mean, that's just the first initial resistance, the first initial support. Down the line, you can calculate further resistance and further support, but that's just purely an introduction to pivot points today. So there you go. There you go. Don't forget, you can ask me questions anytime you wish. Well, I've got a question here. What's your favorite chart pattern? Which is the most reliable? Okay, great question, Mr. Arnold. Thank you for that. Really good question. Like I say, first of all, and that final, I will go through some of the patterns I prefer to use, etc. Like I do like to use pivot points, for example, but we'll talk about some chart patterns and I'll show you some examples of how I like to do it. But the most reliable, that's there's no such thing because nothing works all the time. Nothing is, most reliable. It's just ones which you're more comfortable in spotting and understanding, I think, is what suits you and how you can identify them better. That's the difference. I don't think for a second there is a reliable pattern above all of them. We should say this is the one to use because that's the most reliable. But to answer your question, the patterns I like to use rectangle chart patterns. In other words, it's like a form of price action where I try and look for key areas of interest where an asset's been sold from a lot or an asset from where the asset's been bought from a lot. Basically, I use a lot for range trading on that. And I'll give you an example of that. For example, I've got one here with Bitcoin, for example. If we have a look at Bitcoin. Now, as you can see, if I pull out a bit and then we can go back in a bit closer. Let's have a look. It's on a daily. So I always often look at the daily because I prefer daily signals. Here we go. As we can see here, I'll get a bit closer. There, that's easier to see, isn't it? So, for example, here's the levels I tend to look for. I look for where the buyers have been. As we can see, the buyers are there. So that's obviously the potential area of interest, which is $20,355. And at the same time, I look for where the market's been buying in at, which is $1,838. So that's where I tend to look for. And I tend to put those levels in. So when a market is ranging, I always look for where the buyers and sellers are. And that's the sort of pattern. That's more like a rectangle pattern there. It's more like, it's at the same time using a bit more price action in it as well. So that's my preference. That's what I prefer. But like I always say, trading is personal. What works for one person doesn't always necessarily work for the other person either. Okay, so it's got to be down to your own personal trading habits, your own personality, and the type of trader you are. Are you a day trader? Are you a position trader? Are you a scalper? Are you in and out the market? So then you've got to fit those to your personal needs, as always. But thank you for the question, Mr. Arnold. It was a great question. I really, 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 really appreciate it. I really do. And like I say, the answer to the other question, the other ones I do like is the double top as well and double bottom, because again, I think that's quite, once you get familiar with it, it's quite easy to reasonably identify it. So yeah, the double top and double bottom, again, when you're accustomed to it, can actually work for you as well. But again, like I say, all trading is personal and nothing always works all the time, just to say. Remember that. I keep telling you that. If it is, then trading would be easy, and trading is not easy. Is there any other questions at all? That's a great question. Thank you for that. Any other questions? Or anybody which wants to simply say hello? Or tell me what they think. I mean, did everybody understand that? Did I explain it slowly enough? Clearly enough? Is there any questions? Anybody wants me to go back on any particular area and discuss it again and mention it and talk about it? Or is there any other suggestions for any other topics you might want me to do in the future? I mean, any other topics people like to do? Because like I said, don't forget, excuse me, #ask. What would you recommend to start with a beginner? This is a good question. Again, what would be easier to spot? Excuse me. Excuse me. Right. For a real beginner, for a proper beginner, I would first suggest you learn the absolute basics. Basics, like how to calculate a pip. What is a pip? I will learn how to identify a bullish candle, a bearish candle. And to be fair, if you're starting off with chart patterns as a beginner, have an understanding of probably the most, the most easier visual ones to spot, which is the double top, double bottom. But what I would also suggest for a beginner is you take your time and you learn the mechanics of trading first before you rush into understanding technical analysis. Okay, because technical analysis is a huge chapter in trading, and it takes a long time to master, and it's also down to your own personal view of how you take it in and how you read it. So as a beginner, keep watching these #Ask episodes, #AskJames episodes, and again, keep coming in with suggestions. But that's a good question. It's a very good question. Take your time, understand the basics. For example, what is Forex? For example, what is FX? What is a pip? And then slowly grow into trading, and sort of understand, make sure you understand what the resistance is, the support is, because I often say resistance support, but for the beginners, you might not understand what that is. So these are the certain things you need to understand as a beginner. Oh, brilliant. Good stuff. And always, like I always say as well, remember, trade safe as well. Is there any other questions at all? Anybody else like to ask me anything? My aircon's playing up, so I'm a little bit hot. My apologies there. I mean, is any subjects in the future anybody like me to do? It could be anything, market or trading related. I mean, let's face it, the episodes we've done so far, we've done candlestick patterns, an introduction to candlesticks. We've done an introduction to fundamental analysis. We've done trend lines, and we've done trend lines. We've done market jargon, and we've done an introduction to moving averages as well. So today we've done an introduction to chart patterns and pivot points. Is there anything else anybody like me to cover? Maybe market sentiment or psychology of trading. That's always a good one. I've always liked the psychology of trading because, one of the biggest battles traders face, doesn't matter if you're new to trading or you've been in trading for a while, is the battle of psychology, controlling your reactions and your emotions in trading. That is one of the most challenging, most difficult things to do in trading, is that. And that's a real mountain to climb. I mean, just to give you a prime example of that, there's such a thing called the battle of hope and fear, which is every trader on the planet, every trader who's ever started always goes through this battle. And this battle of hope and fear, and this is how it plays out. If you're in a winning position, okay, you see green, you sort of get excited, you get happy feelings, but then that sort of gets replaced by scary feelings because you think that happy feeling is going to go away because you think that market is going to turn against you in a minute, and you close the position too quickly, taking a small bite-sized piece from the market. When you have a losing trade, you think differently. You think of hope, and you hope that it's going to come back again. You hope that you've seen this market before. It often bounces back. So you hold on to that trade for longer, hoping it will come back, and it doesn't. And the loss gets bigger and bigger and bigger before you get tapped out. And the problem you then face with that is you have lots of little successful trades and big losing trades, which eventually makes your account negative. So anyway, that's one part, an example of psychology of trading, and one of the biggest battles every trader faces. So I could do something on psychological or market sentiment. We could even do a commitment of orders report as well. We could do something like that, or anything. Risk management, even if anybody, because risk management is extremely important in trading. I always say to many people, make sure you have your risk management and your plan, because let your profits take care of themselves, but make sure you control your losses. So okay, not a problem. If you think of a question later. Feel free to put it in the comment section, either on Facebook or YouTube. I will see it and I will reply to it next time I go live on air. I'll do a next episode of #AskJames, which I have got another topic sent in by another viewer anyway, all set up for next week. But like I say, I need suggestions made by you good people so we can make more of them. And I need to know what you guys want to learn. and what you want to talk about. So anyway, anywho, I'll be back online again later today, of course, to do the next episode of Tixee Live, which will be about the US session, obviously, because it's the US session. That'll be back on at 2 p.m. UTC, so please come and join me for that. Anywho, big thanks, or big shout out to John Arnold for the great question. Big shout out to SMS 790 as always for asking also a very good question. And thank you to everybody who's come along to watch me today. I really, really appreciate it. And I hope you found this video interesting and useful. I really do. Like I say, it's all about, teaching or explaining to you in a simple way so you get a good understanding of it. Anyway, till next time, don't forget these little videos, okay, are for educational purposes only, and in no way whatsoever should be taken as financial advice. I always suggest you do your own research and do your own due diligence. And of course, know the risks at hand before entering any trade. Till next time, every single one of you, trade safe.